Hello, welcome everybody to the fourth of Hassans bite-sized tax seminars, which have been precipitated by the introduction of the Anti-Tax Avoidance Directive. Today we're going to talk about the hybrid mismatch rules, which are unfortunately the driest of the four topics and quite complex, with some difficult concepts to understand. Not an easy thing to explain and not an easy thing to understand. So hopefully we're going to get through it and we're all going to follow. I fully expect people to ask questions. I know in the last two sessions there weren't any questions. They were very reasonably simple provisions that we were talking about, and I expect there to be questions today. Though I will do my best to answer them, but we can always come back directly and discuss specific topics later if you have any need to do so. I'm perfectly happy to help. So we should have this done in an hour, hopefully. But if I overrun slightly, I apologize. So we may as well crack on. I think we've got 14 people, 16 people now. So I've obviously put some off by telling everybody how detailed it is. So let's go straight into the hybrid mismatch rules. So you should all be able to see that now. Hopefully it's going to, okay, right. So as everybody will know, because this is now the fourth session, this has arisen as a result of the Anti-Tax Avoidance Directive in its two iterations, ATAD 1, ATAD 2. In ATAD 1, there was a form of hybrid mismatch rule. It was quite a simple, short provision. It didn't really affect the country arrangements. And now that has been superseded by the ATAD 2 hybrid mismatch rules, which were introduced in January. So let's try and grasp the concept of a hybrid mismatch first. It's quite complex. So the importance of the way this provision works is it targets outcomes rather than specific transactions, though we can give examples of what those transactions would be. But what the outcome that is targeting is where the characterization of either an entity or a relationship or a contract in one jurisdiction and the characterization of that same entity or relationship or contract in another jurisdiction differ such that one jurisdiction either doesn't include income or allows a deduction, and the opposite result occurs in the second jurisdiction. So where if a company in jurisdiction A makes a payment to jurisdiction B, and for some reason jurisdiction B ignores that as taxable income due to the characterization for tax purposes of the payment, of either the payment or the entity, and in jurisdiction A, the paying company is allowed a deduction for tax purposes. So what they're trying to see is that we have an inclusion and a deduction that match, rather than just viewing each jurisdiction as a thing unto itself. It's starting to try and establish that if you get a deduction in one country, that income must be included by virtue of the character of the payment or the entity receiving it in the country that you send the payment to. It's very wide. It's a concept rather than a provision, and it's quite difficult to grasp the idea. But hopefully, when we go through it, we'll see some examples. And I've found some slides which I'll refer to, which the EU Commission themselves produced to explain the various scenarios. So hopefully you'll at least see an example, though it's not exhaustive. And if you want to look up the provision itself, it's contained in Schedule 4, Part 7 of ITA 2010, along with all of the other anti-tax avoidance rules here in Gibraltar. So let's go through what the elements of a hybrid mismatch are in slightly more detail. So the arrangements generally use one of the following underlying elements, entities or documents. So a hybrid entity is an entity which is transparent in one jurisdiction and non-transparent in another jurisdiction. So if you remember, there was some question about whether the UK recognised a Delaware LLC as transparent. And by transparent, I mean that for tax purposes, it is not a taxpayer, and that the income is attributed to the entities or individuals that own it directly, like a partnership. That's a transparent entity. A partnership is a transparent entity. A company is a non-transparent entity in our legislation. An LLP is transparent in our jurisdiction, and you could imagine, because an LLP is actually a corporate entity, as a legal personality, then another jurisdiction might treat a Gibraltar LLP as non-transparent, and there you would be able to get a hybrid mismatch if that was the case. Secondly, we have dual residence entities, which are residents in two different countries for tax purposes, and you can get, or they have a permanent establishment in one jurisdiction and they're residents in another jurisdiction. You can get a hybrid mismatch between the treatment of a permanent establishment and a parent of the permanent establishment. Or thirdly, we could have a hybrid instrument, which is an instrument which is treated completely differently for tax purposes in the countries involved. So most prominently, you would find that one jurisdiction treats the instrument as a debt instrument, and therefore allows a deductible expense, and the second country, the receiving country, would treat that return as equity. So specifically in Luxembourg, there used to be instruments called PECs and CPECs, which were treated differently as equity and debt in different countries. And then finally, a hybrid transfer is an arrangement that is treated as a transfer of ownership of an asset for one country's tax purposes, but for another tax purpose, for another country's tax purposes, then it's seen as, say, a collateralized loan. That's quite rare. That's going to be the least frequently seen version of this, but just to be aware, hybrid transfers can trigger this as well. So in order to boil down those quite complex ideas into some examples, if I was preparing tax returns for a company and I was worried about hybrid mismatches, I would be looking out for branches, permanent establishments, things like Delaware LLCs or similar see-through corporations, limited partnerships, which have legal personality and are deemed transparent in some jurisdictions and not in others. So limited partnerships are a particularly weird creature and related to Scottish partnerships. Some limited partnerships have legal personality that may, or Gibraltar limited partnerships for one, may or may not make them transparent for tax purposes in some countries, but they may be deemed transparent in UK. So you will see the UK has a list which the revenue produces of transparent vehicles. Another one I think would be relevant there would be a Guernsey LP, may or may not have legal personality, and then you would need to consider the position and check, does this give rise to a hybrid mismatch? And from an instrument perspective, a debt instrument where the debt instrument is deemed to be a dividend on receipt may trigger a hybrid mismatch. A dual resident entity, which is resident by incorporation but also managed and controlled elsewhere, may trigger this, or a collateralized loan. So first of all, when we're thinking about the hybrid mismatch rule, so what happens is these hybrid mismatches give a tax advantage in one jurisdiction by allowing either a deduction, which is not then included in taxable income somewhere else, or double deductions, where you can claim a deduction against tax in two different jurisdictions against two different sets of income. But that, in order to get that hybrid mismatch treatment so that it's in scope of the provision, they need to be between connected parties, there needs to be a permanent establishment, there needs to be an element of connectivity between the two parties. You don't need to worry about hybrid mismatches if you're dealing as if at arm's length with an unrelated entity, unless you have what's called a structured arrangement, and we're going to talk about that later. But just so that you are aware, you either need to know you're doing it, or it needs to be done between connected parties for this to be a problem. Completely commercial arrangements will not be a problem, as long as they're not structured that way. So let's look at the definition. So this is, I apologize for those of you that already understand these things, but let's just lay the groundwork. A deduction occurs where an expense is allowed to be set off against income when calculating the taxable profits of the taxpayer. So income which is not included is, expenses which are not included in the tax calculation do not amount to a deduction. Secondly, an inclusion occurs where a piece of income is included in the calculation of taxable income. So if income is not included in the tax calculation, then there is no inclusion. And for hybrid mismatch purposes, that is that non-inclusion or inclusion has to hinge on the characterization of the entity or the transaction. Thirdly, permanent establishment is a branch or agency as we would know it under our tax legislation in another jurisdiction which meets the criteria of the OECD Model Convention, and you will find that definition inside the UK Double Taxation Treaty. We don't have a solid definition within our own domestic legislation. So there are various types of mismatch outcome. And remember, we're looking for outcomes. The outcome is what's important, not how we arrive at it. So first of all, we have a situation where there is a deduction in one jurisdiction and no inclusion in the second jurisdiction. That is, the payer of the payment deducts the payment from its taxable income, reducing its taxable profits. The recipient does not include the payment in its taxable income. So if we have a partnership in receipt, then that would not be including it in its taxable income. A limited partnership would not be including it in its taxable income, but the payer would be deducting. Secondly, we have a double deduction where the payer can deduct the payment from its taxable profits in more than one jurisdiction, or it is deductible against the same tax twice. So you can have that where you have, say, a permanent establishment in one jurisdiction and a parent in another. The parent is the same entity as the permanent establishment, and if for some reason the home jurisdiction of the recipient of the payment, the payer of the payment doesn't recognize its permanent establishment, then it can deduct the payment in the jurisdiction of the permanent establishment, but also in its home jurisdiction. And moving on to the next slide. So actually now would probably be a good time to look at these slides that I found from the EU. So as you'll know, you'll see that this is an EU Commission set of slides. Can everybody see that? So we have here an example of, where is it? A hybrid entity double deduction. So so everything below this dotted line is in a third country, and this is in a member state. A is in a member state. B is non-transparent in the third country. Let's, for the sake of argument, say Algeria. Yeah. So B is non-transparent in Algeria and is regarded as transparent in Italy, say. So B makes an interest payment which is set off against the income of the subsidiary because it's grouped together. A can claim a deduction for the interest payment because B is transparent as far as essentially it's a partnership, say. So A gets a deduction, but B also gets a deduction in its home country. So you can see there are double deductions arising from the fact that B is treated as transparent in Algeria, but, sorry, is treated as transparent in Italy, but not as transparent in Algeria. So here is a hybrid entity deduction without inclusion. So now this is different. So everything above the dotted line is in the third country, and everything below the dotted line is in Italy again, say, for example. It's a member state. It doesn't matter. It just has to be a member state. So B is transparent in whichever member state we want it to be. And C makes a payment to B. C gets a deduction. But because A, the third country, views B as a taxpayer in its own right, A doesn't need to include the payment to B in its accounts. But the member state treats it as if it should be included in A. So the member state doesn't tax it, and then it's similarly not taxed in the third country. So C gets a deduction, and nowhere else in the chain is anybody including it. So the details are not what's the most important. What is important is that we have connected parties, one making payment to another, where because of the treatment of the entities, whether they're transparent or non-transparent, you end up with a payment being deducted and no inclusion of the income, which you can see would be a powerful tax planning tool and has been used quite regularly. Finally, you have a hybrid permanent establishment with no taxation without inclusion. So the third country, the non-member state country is below the line here, and the third country does not recognise the permanent establishment. Therefore, B is not taxable because there's no taxable presence in the third country. The member state recognises the permanent establishment and therefore will not seek to tax it under the relevant treaty, which means that A will not include it and the third country will not tax it. So you've got nobody taxing income arising from the characteristic of the entity in question. So go back to the slides. So let's now then go back to my slides. So there is a list of specific hybrid mismatches in the law. There are 5 of them. 6, sorry. The first is that a payment under a financial instrument gives rise to a deduction without inclusion. So that is our, is it equity, is it debt instrument from Luxembourg. Sometimes the paying company will say this is loan repayment, and the receiving company will say, oh great, I've got a return on my equity investment. That payment on the equity investment may well be subject to exemptions or whatever. But as long as what you get is you get one side of the equation deducting and the other side of the equation not deducting, and the reason that occurs is the nature of the financial instrument, the treatment of equity as equity in one jurisdiction, the treatment as debt in the other. Secondly, we have a payment to a hybrid entity. And a payment to a hybrid entity that gives rise to a deduction and a non-inclusion as a result of a difference in allocations between jurisdiction of hybrid entity and that of participators. So that is a situation where a payment is made, which is deductible against tax, and it's made to an entity which is seen as non-transparent in the jurisdiction of the payer, but is seen as transparent in the jurisdiction of the recipient. So therefore, it's not included in the recipient jurisdiction by virtue of the difference between the nature of the characterizations of the entity. Thirdly, a payment to an entity with a permanent establishment that gives rise to a deduction and non-inclusion as a result of those permanent establishment and allocation of payments. So that's the third example that I gave before, where one jurisdiction, the jurisdiction of the permanent establishment, doesn't recognize the permanent establishment, and then the jurisdiction of the headquarters does recognize the permanent establishment and therefore does not tax the income in the permanent establishment. Fourthly, a payment that gives rise to a deduction without inclusion because, sorry, that's not fourthly, that's a sub. I don't know why there's a bullet point there, my apologies. So, okay, on to the next slide. So this is part 2 of the same specific hybrid mismatches that are designated in the law. The fourth one is the payment by a hybrid entity, which gives rise to a deduction and a non-inclusion as a result of disregarding of the payment by the payee jurisdiction. So where a hybrid entity makes the payment to another jurisdiction and the other jurisdiction doesn't recognize it, and it doesn't recognize that as income as a result of the nature of the paying entity. So that is a parent and a permanent establishment, a headquarters and a permanent establishment, which is very similar to the deemed payment between head office and permanent establishment. Sorry, no, the payment by a hybrid entity would be a partnership payment, paying to its partners. Deemed payment by a head office to a PE, which gives rise to a deduction and a non-inclusion, and the payment is disregarded by the payee jurisdiction. And finally, any event which gives rise to a double deduction. So you can see that whilst the actual characteristics of this covers pretty much all the possible outcomes, it's the outcome that's important of this non-inclusion and deduction arising from the hybrid nature of the entity or the documentation, and any double deduction. Double deduction is always a hybrid mismatch. So the good news is that there are some exemptions, and they're quite. One of them is quite wide. So the first one is that any return on a transferred financial instrument where the recipient is a financial trader and the payment is under an on-market trade. So this is to stop people being caught by this just by virtue of buying, when their trade is being a financial trader, just by being caught by purchasing a traded instrument. Secondly, a hybrid mismatch arises only in the last 3 cases. That's these 3: payment by a hybrid entity, deemed payment between a head office and a permanent establishment, and any double deduction, to the extent that a payment is not set off against dual inclusion income. So where you have a double deduction, you might also have a dual inclusion. It may balance itself out in those 3 particular scenarios, so that's okay as well. And then finally, and the most important exemption, a hybrid mismatch can only occur between associated enterprises, or a taxpayer and an associated enterprise, or a head office and its permanent establishment, or between 2 permanent establishments of the same company, or under what is classed as a structured arrangement. So a fully commercial, uninfluenced by the tax treatment, arm's length transaction cannot give rise to a hybrid mismatch. It is only seeking to undermine deliberate tax planning, not accidental tax effects, which is nice to know for those of us that have to go and find them. So we need to understand what a structured arrangement is. Well, that's any arrangement which gives rise to a hybrid mismatch, where the mismatch outcome is priced into the terms of the arrangement. So there's a sort of quid pro quo going on. It's understood that it's going to occur, and that's affected the pricing of the arrangement. Or an arrangement that has been designed to produce a hybrid mismatch outcome deliberately, or unless the taxpayer or an associated enterprise could not reasonably have been expected to be aware that a hybrid mismatch would occur and did not share the value of the tax benefit resulting from the hybrid mismatch. So you have a structured arrangement is anything that you basically design or that you price into your arrangement unless you couldn't reasonably be expected to know. Now, we come back to what couldn't reasonably have been expected to be aware of on regular occasions in these lectures. If you are a tax literate fiduciary with a team of accountants and you're taking tax advice, then you can reasonably be expected to be aware of what's going on. What would not be reasonable to know is if you inherited a structure, you weren't tax literate, and you just made a continuing payment in a large group, and it just sort of carried on, and then you would probably have a reasonableness defense about not knowing. But let's not forget, you also need to not share in the value of the tax benefit arising from the hybrid mismatch. So the taxpayer itself didn't share in the benefit; it was somewhere else. So basically, engineering a hybrid mismatch negates the exemption, regardless of whether you are associated to the entity. So let's imagine that that's all very clear, which it isn't, and things should be analysed on a case-by-case basis, and you need to be, if you think that you're in a position where you've got a hybrid mismatch, you should be reaching out to your accountants and to your tax advisors to discuss with them whether this is the case. Let's say you've identified one. Well, what happens if you have a hybrid mismatch rule? Hybrid mismatch. And that's the primary rule and the secondary rule. These are the two aims of the two requirements, on the member states to on how to proceed when a hybrid mismatch exists. So the primary rule is that in the case of a hybrid mismatch, a deduction must be denied in the paying state in order to neutralize any mismatch that arises. So the payer gains no benefit from making the payment. So that's quite easy to do inside the EU because everybody is obliged to implement the directive. But if that's a third country, if the paying country is a third country outside the EU, then there has to be a secondary rule to deal with hybrid mismatches that arise and a deduction is not denied by the paying state. Let's say the payment was coming from somewhere like America. I don't know if America has hybrid mismatch rules that would match this, but let's say that they don't. America makes a payment, it's received, it's not included in the recipient country, but the deduction is still allowed in America. So then you fall back on the secondary rule, and under the secondary rule, if the deduction is not denied by the paying state, then the recipient, the receiving state, must include that payment into the tax base of the recipient. So that means if a recipient entity receives a payment that has not been denied as a deduction in the other state, then it must pay tax on that. Now, that's going to be quite interesting on how that works under our law. I don't think that's completely clear as yet. So, part two of what happens if you have a hybrid mismatch. So, with a double deduction, the deduction will be denied in Gibraltar first, if it is the location of the investor, i.e. the participator in the hybrid entity. And secondly, if the investor jurisdiction does not deny the deduction, then the deduction will be denied here in Gibraltar to the hybrid entity. So you can see that's the primary and secondary. So primarily, if the investor is based in Gibraltar, i.e. the participator, then the deduction will be denied. And if the investor jurisdiction does not deny it, then the deduction will be denied here to the hybrid entity. Secondly, with the deduction non-inclusion, the deduction will primarily be denied in Gibraltar, if it is the payer jurisdiction. If Gibraltar is the recipient jurisdiction and the payer jurisdiction is not denying a deduction, then that amount will be added into the tax base of the entity in Gibraltar. So there you go. There you've got the primary and secondary rules in action. We will deny, and if Gibraltar, we will deny a deduction on the way out, and if the money is coming in, then we will look to the payer jurisdiction firstly to deny, and if the paying jurisdiction does not deny, then we will include. A deduction will be denied in Gibraltar if a payment directly or indirectly funds a hybrid mismatch through a transaction or series of transactions through associated enterprises. So that's like a catch-all to stop the clever people, the clever lawyers and the clever accountants structuring around this. If you use a payment and that then goes into a system that results in a mismatch somewhere else through the system, and it's directly or indirectly funding that system, then you yourself in Gibraltar will be denied a deduction. Ultimately, the effect is that the hybrid mismatch will be negated. That is the entire aim of this very complex provision. So, tax residence mismatches are a special case. And where a double deduction occurs because an entity is resident in more than one jurisdiction, the deduction must be denied to the extent it is not also denied in the other jurisdiction. So if Gibraltar and say UK have dual residence and the UK allows a deduction and Gibraltar allows a deduction and the company has two separate tax bills, then either Gibraltar or the UK must deny the deduction to the company in their home jurisdiction, but only to the extent that the other one hasn't already done it. So you only lose the deduction once. You get one deduction. You can't have two deductions. That's the point. So that we've identified our hybrid mismatch. We've identified what kind of hybrid mismatch it is. And we have either denied the deduction or we've followed either the primary or the secondary rule, or we've denied the deduction, or we've included the income. So for those of us that carry out the actual returning of income on the tax return, the CT1, or the partnership return system that we have, then what do we do when we need to include income? We've identified a hybrid mismatch and we've worked out that something needs to be done and it then needs to be included. So what you need to do is you need to include it in the income of the taxpayer for whom you're preparing the CT1. That is an obligation on the taxpayer. The actual language of the Act is that the taxpayer must include, for the purposes of the calculation of tax, in accordance with Section 11 of this Act, the income. So it must be included. Now, the language in brackets is quite interesting because that takes this income into the remit of Section 11 of the Income Tax Act. So the normal rules for calculating taxable income, I would say, apply to the income which is then included in the tax base. So we need to apply the normal tests as to taxability which are in Section 11 of the Act. In other words, it's treated as if it is any other income under the Act and subject to the normal rules. But ultimately, the obligation to report this mismatch and the income that arises from it, the obligation to report the income that arises from the mismatch is on the taxpayer. You remember way back at the very start where we talked about, of these lectures, where we talked about the exit tax. We discussed how the move had occurred from it is the job of the commissioner to identify avoidance and ignore its existence under the GAR, to the taxpayer is obliged to report his or her or its avoidance. And if a company benefits from a deduction which is not included or some other hybrid mismatch, then the company itself is obliged to identify that mismatch and to report the extra income on its return. And that is a very important conceptual move, and the idea of just preparing accounts in isolation and not worrying about what's going on with payments to connected parties or permanent establishments or any of those things, that's now been superseded by the fact that a paying entity needs to be aware if it is the beneficiary of a hybrid mismatch. And I think this will increase the level of awareness and expertise required at the level of the accounts preparations teams and the CT1 preparation people than the more traditional idea of working in isolation to prepare a set of Gibraltar accounts rather than having a depth of understanding of the group. So, in summary, this is very technical, and this presentation is only a high-level summary, and I apologize for not going into too much detail, but I think that the detail that we've got and it just simply and purely the language that is used in the provision and the directive makes it difficult to understand. The outcome-driven aims of the directive mean that you're dealing with concepts rather than concrete examples, though you can apply those concepts, but you need to be primarily aware of the outcome rather than looking for a list of structures that are the ones that you need to worry about. So as a practitioner, you need to be aware that tax structures which rely on differing treatments of the same entity or document are probably redundant now for tax purposes, not just within Gibraltar, but within the whole of the EU. And if you're making payments from a Gibraltar taxpayer to a see-through entity, you must consider that position if you're preparing accounts. And if you have any doubts, refer to your relevant tax department or to your tax advisors or your Big Four accountant or to Hassans, preferably Hassans, obviously. When you're preparing fee estimates, and you should be factoring this into your fee quotes as a fiduciary or as a lawyer or as an accountant, thinking about tax must be included in the fee estimates. And this is right across the board of all these things that we've talked about. Thinking about tax is a very important part of what needs to be done when establishing a structure in the kind of environment that we work in. There is no closing our eyes to the outside world and its tax affairs and saying, we only know about Gibraltar. You need to be thinking expansively, thinking about how jurisdictions interact, thinking about what might be being done, and preparing yourself to prepare CT1s and things that take into account the potential for inclusion of income, for the denial of deductions, for all of those things. And you should be liaising very closely with accountants in other jurisdictions that are in the same group. Gone are the days where we could work within our little box and basically close our eyes to everything else. So that is the end of that. Thank you very much for your time. I need to stop sharing screen. That's what I need to do. Does anybody have any questions on this difficult issue? Okay. Well, that clearly went better than I thought it did, because it is quite complex. I am fully aware of that. No? Okay. Well, thank you very much for everybody that's attended. If you have any questions about this that we can do one-to-one, please send me an email. You've got my email on the slides. It is difficult, and hopefully I managed to explain it in a way that was understandable. Hopefully you got something from these lectures in general. I think this may be the first time that one of the firms has done this kind of series. If anybody has anything that they'd like me to talk about in other sessions, please feel free.